Hello, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, December 4th, 2015. This was a very volatile week for many asset classes, including stocks, bonds, and currencies, as well as gold. And we had lots of market-moving events. And Mario Draghi delivered his address, as well as we had a jobs report this Friday. So we will also look at 2010, 2011, 2008 picture versus what it is looking now today for a very broad New York Stock Exchange Composite Index. Bonds came under selling pressure, as I said. Gold rebounded as euro rose. Oil really didn't feel much better after the weakening of the dollar. And we'll look at natural gas and we'll see if it's time for it to rebound finally. All right, let's look at S&P 500 SPY. So it's a proxy for the market. You can see that this week was pretty volatile. Here we had what looks like a breakout above this levels here, right here. But then next day we had what I thought was an outside reversal with this big red candlestick kind of almost engulfing this entire white candlestick and a very strong follow through on Thursday here. But it looks like there was at least some support that was found around the 200-day moving average, and the next day, following a apparently very strong, or rather, market participants thought that the jobs report was strong enough, and the prices actually rebounded quite strongly, so almost 2% for S&P 500 gain on Friday. So this outside reversal possibly is still in play, but we could potentially see a breakout above this level too, and that would open the door to new highs. Now, in the next few minutes, I will present my case why I think that, generally speaking, I think we're already in a bear market. But for now, let's look at this chart as well. Also look at this volume pattern, this unbalanced volume. Looks like it's kind of trending lower while the index itself is clearly, it's from here to here it was trending higher, but the volume patterns are still moving lower. So if we retest this low here in November and we fail here, this would open the door to, well, at the very least, this gap needs to be filled, and potentially even a move lower to retest September and possibly August lows. All right, so next let's look at the various at the New York Stock Exchange Composite during the 2011, 2010, 2008, and now. All right, so this is New York Stock Exchange Composite Index, a very broad representation of the market, and this is a 2011 picture. So we had this picture currently is the most compared to model of what we have right now in the markets. So we had a drop, pretty steep drop here, and then we had a crossover of the 50-day moving average going below the 200-day moving average. So here we have four indicators. We have the 50-day and the 200-day moving average as a kind of like a pair. When the 50-day is above the 200-day, the market is bullish. Right here, when the opposite happens, the market is bearish. Next indicator is a New York Stock Exchange new highs, new lows indicate new highs less the lows divided by the total issue. So this is a percentage of new highs, new lows, new highs less new lows. And we're going to keep a bullish bias when this number is above 5%, and we're going to continue keeping a bullish bias until this number drops below negative 5%. So here in August of 2011, we had a drop below, so we're going to start keeping a bearish bias. The same goes for BP NYA, which is a bullish percent index. For NYA, if it drops below 40%, we're going to keep the bearish bias until we get above the 60% level. And the same goes for percentage of stocks above the 200-day moving average. If we drop below the 200-day, about the 40, below the 40%, then we're going to keep a bearish bias until finally we're going to switch back to the bullish bias when we go above the 60%. So here, let's put it all together, and this is kind of like a decent system, even as it stands on its own. If we have 3 out of these 4 indicators in the bullish territory, we're going to keep a bullish bias, and vice versa. If we have 3 out of 4 the indicators in the bearish territory, we're going to keep a bearish bias and short the rallies. So here we have 4 of the 4 drop into negative territory. Then we had 2 recover, and then finally we had another third one recover here in 2012, and then we had a pretty powerful rally from here on. I'll just fast forward some, but you know, it was a pretty powerful rally here to this level here. So next, let's look at 2010 and what it looked like back then. Okay, so this is a same exact chart, but as it looked in 2010. Here also we had a pretty strong selling pressure. We had a crossover of the moving averages. Notice that the interesting part here, that this indicator, New York Stock Exchange high lows, percentage of stocks, new highs less new lows, it never actually dropped below -5%. It actually came very close, but it never dropped below. So that was already, you know, you can see that this was a different type of corrective action back in 2010. The bullish percent index also did drop right here. I didn't mark it, but it did drop, and then also the percentage of stocks above the 200-day did drop. So 3 out of 4, 1, 2, 3 did drop. So at this point of the game, we could have considered this to be in a bear market. But then very shortly afterwards, we had you know, a quick recovery here. It was 3 out of, you know, 2 more indicators joining the NYHL percentage above in the bullish territory. So this was you know, quite a shallow correction, and then we had another powerful rally there afterwards. Right, next is a 2008 picture, and here you can see it looks quite a bit different than it was in 2010 or 2011. We had the NYHL percentage drop back in November of 2007 into the bearish territory. The bullish percent index did the same thing, together with a percentage of stocks above the 200-day moving average. So already here in November, we could say that this was already kind of somewhat bearish. Then we had a bearish death cross here. Now, we did have one of the indicators turn back into the bullish camp, but notice that BPNYA just came very close, but never actually crossed into the bullish camp. But even if it did, it would have been only 2 out of the 3 indicators, and then you know, the actual moving averages never crossed one above the other. So these you know, set of 4 indicators is already quite robust to determine the trend of the general market. NYA is pretty much the general market. So next, let's look at what the picture is right now in 2015, and what does it look like, where is this going to go. Okay, so this is a picture as it is right now in 2015, and as of December 4th, 2015. So we had, you know, some similarities and some differences, of course, to what I just showed. But let's look at, you know, at the indicators as they are. So we had NYHL percentage of, you know, NYHL crossed back into the bearish territory here back in actually June. So this is well before the August drop. Already there was some kind of a selling pressure happening. Then we had percentage of stocks above the 200-day moving average drop into the bearish territory here. Also in July, a bearish cross here in August, and then finally a percentage of bullish percent index also crossed into bearish territory when we had this nasty drop in August. Now, so far, as of today, we have 0 indicators in the bullish camp. So far, we have not had a bullish surge in the new highs, new lows indicator. You can see that it was still meandering as a negative in the bearish territory. It kind of came above, into the bullish territory, but it never actually crossed above the plus 5%. And in fact, today on Friday, when it was a very strong day for the general market, you can see that new highs outnumbered new lows quite significantly. The same goes for bullish percent index. We still see that we have not crossed above the 60% mark, and the same goes for percentage of stocks above the 200-day moving average. Also, we have not crossed into the bullish camp. So what this means to me is that I'm still keeping a bearish bias. I will change my bias once I see actual evidence of improvement in the market breadth. As of right now, and the momentum, of course, too. As of right now, I don't see that evidence, and I will continue keeping my bearish bias until I see actual quantifiable evidence of improvement. Of course, the fireworks really occurred following Mario Draghi's speech this Thursday. Look at this just enormous candlestick with a close below this breakout level. So it's a pretty bearish looking candlestick. And then, of course, on Friday we had an inside day where this whole candlestick was inside the previous day's candlestick. So, it's kind of difficult to say where this is going. I mean, we came off of almost 52-week highs. This was 171. We came to very close to 52-week highs. So I still think that there will be, at the very least, an attempt to make a higher high, unless, of course, we completely collapse, which I seriously doubt, because if Janet Yellen decides to raise interest rates in December, then it would make sense that the dollar would actually rally against other currencies. Anyways, I don't normally trade currencies, but this is important for various commodities, and we'll look at and also bonds, of course, too. So we'll look at bonds and then commodities next. All right, next let's look at TLT, United States 20+ year Treasury bond fund. So, we had a pretty powerful rally here off of this support, and it came, to now apparent looking trend line at the sloping down trend line, and it kind of bounced right off of this trend line with a big gap down on Thursday, and then it just followed lower. On Friday looks like an inside day again, so this could be either a potential further consolidation with a move lower, in which case it might retest this support, and if it doesn't hold, then we're probably going to retest this support. Alternatively, of course, is it's possible that stock market corrects, as I said before, and then the fear trade will be on again, and then money will rotate back into bonds. There's all kinds of scenarios. If you look at this could be considered a bear, like a rising wedge, and this is a clear break of that rising wedge. So this is certainly not a good sign if you're a bond bull. If you're a bond bear, you can, of course, like I said, you can retest the lows here. Now let's look at another bond fund, which is a municipal bonds. And municipal bonds look quite different than the TLT we just looked at. First of all, we hit all-time highs here. And then on Thursday, we had a correction, but this was a very minor correction compared to what we had for TLT. But nevertheless, same thing also an inside day on Friday. So, I mean, I'm more bullish on this, of course, than I'm bullish than on TLT. So, this could be like a consolidation before a move higher, which is also a possibility. All right. Next, we'll look at gold. Next, we'll go into commodities part of the presentation. Okay, so gold daily spot price chart. I mean, I still think the gold is still long-term bearish. We had this just tremendous drop here to multi-year lows. And this is Thursday's action right here. Looks like we had a kind of like a hammer candlestick, I guess, with Dragne's announcement and market's reaction to it when euro gained, I think it's like 3.5%. Euro gained 3.5% in just one day. Next day on Friday, of course, we had a continuation higher, and looks like we're in the middle of a counter trend bounce. So this broken support, the support was broken right here by a close below it, but looks like we are now possibly have negated this broken support and are moving higher. So, we have several resistance levels from this broken support here at 1103, and then also this attempted rally that was stopped at this exact level. So this is a logical place for traders to take profits, and if we don't move above it, then we potentially just fail right there. The next good level to fail for gold would be around 50-day moving average here. And then, of course, the next one is 200-day moving average, where it has failed numerous times in the past, and then back here also. So for now, short term, very short term, looks like it's bullish. What's going to happen, afterwards is hard to say. All right, let's look at GDX, the gold miners ETF. This is, of course, a much more volatile security, and I've pointed this level out on numerous occasions in the past. $13 seems to be very important to GDX, and yet again, we failed to break below it right here on the 17th of November, and kind of rallied off of it. But once again, this is a very bearish security, so it's similar to gold. Where are we going to look for failure? And of course, a great place to fail would be around this area, 1575, where the broken support was, and then possibly higher at around 200-day moving average. It hasn't even touched the 200-day moving average in more than 6 months. So, we'll see where this rebound carries it. All right, next let's look at oil. West Texas Intermediate light crude oil. Quite bearish picture as well. We're approaching multi-year lows here. This is multi-year lows here at 37.75. This week we had what I think was a bearish wedge breakdown with this bearish looking candle on Wednesday. So it was kind of like a channel, uptrending channel with a breakdown here. So bearish wedges, bearish wedge breakdowns call for more downside because it's a continuation pattern. So potentially we could see new 52-week lows and of course multi-year lows. Interesting thing is that the oil was not as impressed with a rally in euro as was gold. So I think it more depends on the supply and demand. And I think the Saudi Arabia is pumping oil and everybody else is pumping oil. So price is clearly dropping because of the excess demand. Where this is going to, we potentially could break down, below these levels and continue lower. So I think last week I estimated we could go below $30 potentially before any kind of strong rebound might materialize. This is just an estimate though. And then relative to oil, of course, is energy ETF XLE, also very bearish security. We had a rebound here, and I think this could be like a head and shoulders kind of pattern. And if this is a head and shoulders pattern neckline, so today on Friday we potentially had a neckline break because we closed below at 64.70, and this is the lows here 65.11, 65.20. So we did close below these two lows. So if this is indeed a neckline break for XLE, let's just do a quick estimate of how far XLE could drop. And well, let's be conservative from here. This is about $6 more. So maybe around $60. So yeah, that makes sense. It would probably retest the lows here around $60 if this neckline break is indeed valid. So natural gas daily spot price, end of day spot price. Thursday we hit multi-year lows here intraday and possibly have rebounded with a hammer-like candlestick. So again, it's really difficult to pick bottoms in a downward trend in security because I thought this candle right here, if you listen to my previous several videos, I thought this was the intermediate bottom, and then we rebounded, and then I was like, oh, maybe I'll hoping to go short again, but we didn't even get above the 50-day moving average, this red line, so I didn't really open a short position. Now hopefully we'll get some kind of a rebound, maybe above the 50-day moving average, and then at that point I will look for a short entry opportunity. At this point of the game I have no positions in natural gas, so I'm just kind of watching the action and seeing if there's any kind of opportunity to take. All right, let me very briefly tell you how to find us on the internet. Please go to MasterChartsTrading.com. We do have trade alert services that are now alive and well. We have quite a bit of subscribers, and subscribers are really getting some good information and good alerts as well. So it's only $24.95 per month, sorry, and you get a 3-week free trial. So please consider signing up. It's a great value. Also, if you go, of course, we have a blog and video section, and this information will be posted on the blog section. If you go to public charts and social page, you will see that we have various links here to public charts page, where most of the charts you see here will be posted. We also have Twitter, Facebook, YouTube, and StockTwits accounts, so if you have those, please follow us there. Subscribe to our mailing list and you will get a special price for our trade alert services. That's it for this week's recap. Thanks for watching and have another great trading week.